It's been a very busy year once again. Having completed the turnaround, the focus has been very much on executing our strategy. And this is showing in our results. Our revenues are up 6.6% to above £150 million, and that has flowed through to a 30% increase in our operating result and a 40% increase in earnings per share. While our origins go back to 1792, we've always been a very innovative company. And nowadays that means about harnessing technology to improve the client experience. That's best exemplified with Charles Stanley Direct, where we continue to make great strides. Assets under administration are up 21% over the year and is now a profitable division. Indeed, across all of our divisions, we're striving to use technology to make the customer experience smoother, easier, and more intuitive.
The highlight for the year is that the firm delivered an improved financial performance on all key metrics. Turnover was up 6.6% to £150.9 million. The reported profit was up 30% to £11.4 million. On the balance sheet, that strengthened, and the two key measures I would look at are cash, which increased significantly to £65.6 million, and our regulatory capital also improved by a bit over 20% to 74 million. What does that mean for shareholders? The board is recommending a final dividend of 5.5p, which will make 8p for the year, an increase of 33%. The critical thing which drives our profitability is our funds under management. Those actually ended slightly down on the year because markets in the last quarter, or the first quarter of the calendar year, declined quite sharply and actually have rebounded since. So our assets for the year were marginally down, but the average assets, if we look at where assets were over the whole period, they were up reasonably strongly at a bit over 10%. Within the funds under management, the two key areas that we focus upon are our discretionary assets, which were up 7.9% to 12.3 billion, and the execution-only assets on the Charles Stanley Direct platform. Those were up a little bit over 21% to 2.3 billion. So, we're sort of pleased with that progress. And indeed, Charles Stanley Direct moved into a profit in the second half, which was, a big milestone for that business. And we see, really good opportunity for that to continue because there's a lot of operational gearing in Charles Stanley Direct. Last year, our operating margin was 7.1%, and on a like-for-like basis, this year it's 8.8%. So it has made some progress, but if I'm candid, it's not the degree of progress that we had hoped for. Although we have achieved asset growth, the level of organic inflows that we've achieved, as opposed to growth happening because of markets, has not been as strong as we would have liked overall. And secondly, and it's a common theme across the industry, is that costs in certain areas continue to grow. And the last year we had sort of heavy pressure on the regulatory front dealing with MiFID and GDPR. So the critical question then is, do we still think that our target operating margin of 15% is achievable? And the short answer is absolutely yes. I remain completely convinced that the opportunity within this business for a host of reasons to get there is achievable.
The turnaround component of the strategy has been executed already. We're now very much focusing on the detailed execution of that 5-year plan. There are two key components. First, driving top-line revenue. And to encourage that, we've built a marketing and sales capability, which is beginning to show good results. The second component is operational efficiency. We need to make sure that as we grow our revenues, more and more flows through to the bottom line profit. A whole range of initiatives are underway to ensure that we can be as efficient as possible, whilst always focusing on high quality client service. Financial markets have been very strong in recent years, but we certainly can't take that for granted. There are plenty of risks out there as we move forward. whether they be related to the United Kingdom leaving the EU, or stresses and strains over global trade, or indeed a global tightening in monetary policy, it's easy to identify things that could bring an end to the bull market. Were that to happen, not only is it negative for client returns, but it also impacts us as a company. Increasingly, we offer discretionary fund management to our clients, and that's based on fees rather than commissions. And that means our earnings are more exposed to the markets than they might have been in prior periods. Beyond external markets, we still face the challenge of increased regulation. It's very understandable why regulation has had to increase since the financial crisis, but it does come at a cost and it can be a distraction. With regard to MiFID II and GDPR, we've executed those. Those are behind us. There's more regulation ahead, and we will, of course, execute anything that's required of us. First of all, I'm delighted the board has approved an increase in the full year dividend from 6p to 8p, so a 33% increase, very much in line with our progressive dividend policy. More generally, we're committed to delivering increasing profits to shareholders, but importantly, an increase once more in the profit margin. We've come a long way, but there's still a long way to go. But we are determined to become the UK's leading wealth manager, and I feel our destiny is in our own hands. All of our staff are committed to make this work. It won't be straightforward, but there'll be no shortage of effort and commitment. And I'm very confident we can do this.